If you own a home and you're thinking of buying a new one, you may hear realtors and lenders talk about bridge loans. They're magical loans. They have many different use cases. And in this video, I'm going to explain exactly what they are, when and how they're used, and give you a full understanding of how much they cost. First, what is a bridge loan? A bridge loan is a short-term loan used to provide temporary financing to a borrower while they work to secure longer-term financing or meet some other financial goal. It basically bridges the gap between two financial points in time, hence the name. When someone thinks of moving, mapping out the logistics can be quite stressful and really hard to get your head around. In a perfect world, everyone could sell their house first. They could get the equity, move directly into their new home with absolutely no stress. But in hot housing markets, that is rarely possible, especially when inventory is low. It can be near impossible to find a buyer for your home at the exact same point in time when your new dream home hits the market. For most people, only two options exist. You can try to buy a new house before selling yours, which is what most people try to do, or you can sell your home first, move into some temporary living situation while you wait to find another. And if we're honest, that sounds awful, right? Especially if you have children. The biggest hurdle for most people is that their down payment is tied up as equity in their current home. For others, they just don't have enough income to qualify carrying two mortgages at the same time. It's when you find yourself in these situations that bridge loans can be a perfect tool to allow everything to fall into place. Now let's talk about a few specific use cases on how exactly people use bridge loans. If you think of a bridge connecting 2 points in time, moving from one property to another, know that that bridge loan can be placed on either home, and in some cases, both houses at the same time. The most common is where equity is pulled from the current home and used in some way to buy the new property. I'll discuss this method first, but later in the video, I'm going to dive into some more creative use cases where the bridge is placed on the new home. A bridge loan on a home you currently own is really no different than a cash out refinance or taking this big home equity line of credit or second mortgage. You're basically taking a new mortgage that's greater than your current loan to pull cash out for some strategic purpose. As an example, let's say you have a mortgage balance of $500,000 and you take a loan for $650,000. Then you would get $150,000 in cash before closing costs to use as you wish, right? And most use that money as a down payment on their new home, but that's not the only thing that you can do with that cash. I've had many clients who decided to pay down other debt, such as car loans, credit cards, student loans, to either enhance their loan approval, maybe increase their credit score, or decrease their carry costs while they're trying to sell their other house, right? They have two mortgages going at the same time. Now, others will pull out extra cash for upgrades, for staging that current house to get top dollar when they sell. I've even seen people take out extra cash to renovate the new house before they move in, just to allow them a little bit more flexibility. You can basically use that cash for pretty much anything you can think of that helps make that move possible. Now, for our veteran clients, there's a scenario where the bridge refinance is used without actually taking out cash. We use the bridge refinance to free up their eligibility so they can use a VA loan on their new purchase without selling that house first. But there is one major requirement that's needed for all of these bridge refinance options, and that's equity. Lenders will typically allow you to borrow up to 80 or 90% of the value of the home. They would then take that loan, pay off any liens that you have on the property, then pay off any consumer debt should you choose or if you're required, and then give you the balance remaining after closing costs to do as you see fit. Now, without sizable equity positions, the bridge loan really doesn't help that much. An alternative to a bridge refinance, and quite frankly, a lot less expensive, and we'll talk about costs at the end of this video, is to get a home equity line of credit. These are interest-only loans that act like credit cards. The high credit limit is a percentage of your equity, and the rates are typically tied to the US prime rate. And you only pay interest on the money that you use when you use it. The issue here is that HELOCs or second mortgages, they can take a bit more time to close. And those lenders are not really in the business of doing short-term loans. You know, if you call them up and you're like, hey, I need a HELOC because I'm buying a new house, they'll likely deny the loan. This is generally something you need to set up well in advance of getting started looking at buying your new house. Okay, now let's switch to the bridge purchase. I find this structure is by far the most underutilized feature of bridge lending. There are two key scenarios where I use these frequently. Remember, a bridge loan simply means a short-term loan that allows you to secure longer-term financing. So if you're trying to buy a new house without selling your current, you need to have enough income to qualify carrying all the monthly debt. That means your current mortgage, any bridge loan payment or a HELOC that you might have on that house, any other consumer debt like car loans, credit card payments, and the new proposed mortgage. And for many people, that's just not possible. A bridge purchase loan is one given using common sense underwriting. The lender just wants to know if you're within, let's say, 3 or 6 months that you can sell your home and pay them off with a refinance. They're just going to look at your situation, the equity that you have in your house, the location, the market, your financials, and in most cases, if it makes sense, the loan gets approved. And while there are general underwriting guidelines to follow, common sense prevails in all of these cases. If it makes sense, and timing is the only issue, these loans generally get approved every time. Another scenario may be to just win the house. You see, mortgages have regulatory requirements. You cannot physically close a residential mortgage in less than 8 calendar days. It's just impossible. Regulation prohibits it. Now, most good lenders could get a purchase closed relatively easily in, let's say, 2 weeks. However, bridge loans are exempt from that regulation, and they can close in just a few days. I have scenarios where I talked to a client on Tuesday and we closed that same week on Friday. Now, this speed can play a huge role in beating out competition by telling the seller that you'll just close much faster. Or maybe it's someone that has a loan falling through with a lender and they'll be in default if they miss their closing date. Either way, it's always nice to know that speedy solutions exist. Now let's talk about the cost. If there's one downside to bridge loans, it's this right here. Because the loan is a short-term loan and in a way highly risky, the rate is generally higher and there are additional upfront costs. A typical scenario might be a rate that is 2% over prime rate, and the upfront cost might be something like 2 points or a fee that is 2% of your loan balance. Now, these fees fluctuate over time, so just know that this quote here is very loose. For a bridge refinance, you also have your jurisdiction's local fees for recordation taxes, settlement attorneys, title insurance, appraisal, lender fees, things like that. And on a bridge purchase, you'll have the cost associated with refinancing that loan into the permanent loan, just like a normal refinance. So let's run through an example of a $600,000 bridge loan in Washington, D.C. The traditional refinance fees would be roughly $5,000. And then you would pay 2 points, which would be $12,000 or 2% of the loan amount. That means your total cost would be $17,000. Your interest-only payments on that loan using today's prime rate of 7.5% would be $4,750. As you can see, it's expensive money, but that expense should always be compared to the alternative. As an example, if you sold your home first and you moved into temporary housing, you would have to add up all the moving costs because you're going to have to move again, and the storage fees because your short-term rental is probably not the same size as your future home. And of course, the cost of the short-term rental, that's usually higher, and you might even have lease termination fees. In many cases, you find that the bridge loan costs are quite similar. And with the simplicity it brings your life, it could just make it a no-brainer. When I counsel clients, I tell them that the bridge loan is the loan of last resort, as I want to try and avoid all the closing costs as much as possible. Now, in a perfect world, if you're planning to move, you're going to speak to a lender a few months ahead of time. All too often, couples will look online for months and months, and then all of a sudden, the perfect home pops up and they find themselves scrambling. But with ample time, you could likely avoid the bridge loan. I guess what I'm trying to say is if you're thinking of buying a home, talk to a qualified lender the minute you have that thought of buying a new home. You just can't do that early enough. So there you have it. It's most everything you need to know about a bridge loan. And if you have any questions, drop them in the comments below. As always, you can reach out to me directly. And until next time, I'm John Downs.